This weekend, we are going to talk about three topics. The first one is beyond ESOPs, where we will talk about how you, as a non-resident Indian, can diversify your wealth across the Indian market and take advantage of India's growth story. The second is green hydrogen, where we will dwell into the promising world of green hydrogen and its pivotal role in transition to sustainable energy. The third is an overview on hybrid funds, where we will look at hybrid funds and whether it is the right time to invest in them and are they better than equity funds. So, if you are interested in any of them, click on the description below to register.
An investor depends on certain streams of income for many things. I have known investors who ran their life on the dividend income they received from companies. So that season when dividends come would be their active earning season, and they would keep that money and run their life for the rest of the year. Conservative investors have a high tendency to depend on dividend, not essentially to run their lives, because some of them do have other sources of income, but to reinvest every year into their portfolio, to infuse fresh ideas, to scale up new ideas. They depend on dividend. This is especially true of investors who don't churn their portfolio much. If a person doesn't churn his portfolio much, he doesn't have much liquidity to buy new ideas, and every year it would be natural for an investor to be drawn to new ideas. He is always on the lookout, and some ideas would appeal to him, and he needs to invest in those ideas, and he needs capital. Dividend is often that source of capital. So I have given you two areas where investors depend heavily on dividend. One is to run their lives, and the other is to reinvest and scale up their portfolios. I have been a bit of both in my investment life, and the time when they made dividend tax free in our hands was a golden era. It was an era where we literally had a boon from the finance ministry simply because we were equity investors. This was not available to somebody who was lending to a company or lending to the country through banks and earning interest, but equity investor was kind of placed on a pedestal and given tax free income. That, of course, is now history, and having gained so much during that era, today the government is also making us more responsible by making us pay the highest taxes we pay in our history as taxpayers on the dividend income that we receive. No regrets, but that's how life should be. So the amount of money available today to reinvest out of dividend is significantly diminished, especially if you are a high taxpayer. In my case, it's just 61% of the dividend income, and so the ability to reinvest is significantly lower than it was in the era where dividend income was tax free. But does it mean that you love your dividends any less simply because it's heavily taxed? Let's ask Subra how he feels about dividend income. I have said how I feel, and let's ask him how he feels, and then I will come back and tell you how I feel in the current era of high taxes on dividend. Over to you, Subra.
Thanks. I didn't even know there was something called dividend yield investing, but I did dividend yield investing back in the 70s and 80s, and you will not believe the shares which I got below par included HDFC Limited and Apollo Hospital. Apollo Hospital was available at 9 rupees. It would declare a 10% dividend, so 1 rupee for 9 rupees investment was available. HDFC would constantly be available between say 95 and 97. It used to be a 100 rupee share. It was a good dividend yield share. Tata Power used to be available at a dividend yield of 7% when bank rate of interest was about 9%. So you knew that you would be compensated in 7-8 years, the share price would double, and apart from that you were getting a 7% yield or an 8% yield. That worked well, and you could buy shares like that. There is only one catch to it. I bought Apollo Hospital because it was a dividend yield share. 9 rupees was my cost. The price reached 135. I thought, oh my god, this is too much. It's no longer a dividend yield share, so I sold it. So sometimes your dividend yield theory works, and sometimes you feel hurt that you sold off, and then the company is a different company. It becomes a retail company, it becomes a service company, it becomes a hospital company. So from 9 rupees, it has now gone to 5,000 or 4,500. That's the kind of price journey one has seen. So to be able to adapt, being a dividend yield value investor to a value investor to a growth investor is important in this journey.
That's the point that is most critical, because you bought it as a dividend yield stock, then its sectoral merits started getting recognized, then its earning power start getting discovered, then its superior growth prospect starts getting factored in, then the market starts seeing what you saw as a dividend yield stock as a growth stock. Now, you explained clearly that when it became a non-dividend yield bearing stock, you didn't see it as a growth stock enough. That's all. If you had seen it as a growth stock, then you would not have sold it. Now, I'm going to share one experience with you about some of the companies which I bought in 2011 to 13. Dividend yield was definitely a metric in the decision making. It is a very core metric. But I was also looking at growth as a driver. So when I started looking at growth and dividend yield as twin drivers of an idea, which I did very heavily post 2010, and I continue to do it even now, it did not bother me when the yields fell, because at that point I lay more emphasis on the growth. Whereas prior to that, in previous cycles, I have done exactly what you said. I bought Apollo Hospital, 25 rupees stock price, 2.5 rupees dividend, 10%, same thing. Because I think at that time, I suspect that Apollo was giving yield which will satisfy its investors as a proxy to a deposit.
True, possible.
Yeah, that was the psychology, because a lot of doctors were shareholders, and I think they were satisfying them and keeping them owning these stocks and not selling them by giving them enough dividend.
True, possible.
And ironically, when the price went up, it's only people like us who sold, not these doctors, because they didn't have the time to even do it. We had the time to focus on it, so we ended up selling it. That's an interesting aside on the Apollo Hospital, which I thought was important. And the other point which I feel works better is if you are measuring growth and dividend together. And this is something I have seen very successful investors do for long periods of time.
No, I think just measuring growth in a country where you're not sure of corporate governance is ridiculous. Because the EPS that he shows may not be true, but the dividend is the absolute truth. So there was a time when I used to look at something called the P/D ratio, which this generation won't even realize what it is. We look at PE ratio. Earnings is just imagination. We are not sure about the E at all. Price is a certainty. So the PE ratio makes no sense unless you're 100% sure about the E. But you're 100% sure about the price and 100% sure about the D. So you arrive at a P/D ratio and say at this P/D ratio it is worth buying.
Basically, dividend yield.
Dividend yield. Dividend yield. So the price to dividend ratio is a better indicator because you're sure of the numerator and the denominator. Earning, you're not sure. Also, I like groups. I mean, case in point is the Murgappa group, which has a very clear dividend payout policy. Like the PSUs have today, 30% of VPS we will give as dividend. Then there is clarity. You track the earning, you know how much is your dividend going to be.